All right. Good morning, everybody. So it continues, second day in the FOMC week, and it is one of those rare weeks where we don't hurry up and wait. And it's happened before. I mentioned yesterday that it's possible that we grind instead of sitting in one spot. And sure enough, that's what we continued to do is just grind. And so we got this big gap underneath this. Um, it's kind of unusual to have such a gap up from the highs like that and have it stick. I would still expect that gap to be closed at some point this week because of FOMC and the volatility. We could easily go down there and get it. Doesn't mean that we would stay down there, even if we did go down and get it. But there it is. We continue, and at least we have more info now. Yesterday, we knew it was possible to continue to grind higher and have one of those kind of weeks. And now we know that's what we're getting. Now, at any point, we could just stop and begin to go sideways. Usually, though, if we don't run hurry up and wait, the pause comes late Tuesday into early Wednesday. And oftentimes, when we do get an FOMC week where we grind, it's usually on a QRA week when they overlap each other. This isn't the case because next week is QRA, not this week. And so I don't know. Maybe it's just all of the positive news that came in yesterday. That could be it. The why, I guess, really doesn't matter. We can't anticipate such things. We just have to recognize that there's more than one outcome and then try to anticipate which one it's going to be and trade whatever we get. So at least once it continued to push yesterday, we had a good idea what to expect. So far today, things are holding up well. Small caps are only down 0.25%. The Dow is flat. NASDAQ up by a dime. And the Dow up the most, more than a quarter. So we're covering the gambit. Japan leading the way, not quite at 0.5%. So just all around from one direction to the other, looking at things going on around the world, down 1% all the way up to 0.5%. A bit bifurcated, maybe. We're going to get the 1 year auction today. I think we're on week 44. I think that's where we're at out of the 52-week year. But we're going to get the 1 year auction at 11:30. Always pay particular attention to these auctions. I know they don't get very much attention. Certainly don't get the attention that they deserve. And at 1 o'clock, we got the 7 year. I'm not a real big fan of the 7 year, but I won't ignore data when it's coming in. So just keep your eye on the clock. I'm not really expecting much out of the 9 and 10 a.m. data. But don't get me wrong, it's the same thing. We don't want to ignore data. We just have to look at it and ask, how likely is it that this data is going to hit the market and do anything with it? Probably not. Probably not going to do much. If you are trading tonight, keep your eye on the calendar. Looks like you could get some impact. I never really see Australia do much with the market. So again, it's there. It's just how probable is it that it's going to move markets? I don't know if he's done speaking, but the president was being broadcast across Bloomberg. Uh, he might have wrapped up by now, but be mindful that it likely isn't the only speech he's going to give today. All right, we've talked about the CTA positioning. It's this green line here. While the market continues after that pullback to run up, break out, and continue higher, the CTA positioning isn't even halfway back to this pullback level. We want to see their commitment, and right now we don't have their commitment. They're getting back in a little bit. We can certainly see that, but we want to see them get through the half back of this pullback and at the minimum get back up to this previous level. Their commitment is a testament to the strength and the durability of everything that's happening. So, we don't want to see them getting out and losing faith. Same thing on the NASDAQ side. I guess with this one, though, you could look at that and see that their commitment is even less here than it was in the S&P. They continue to exit out of their silver positions. And out of their gold positions. They didn't even get back to the previous level of commitment. All right, we closed at 68.47 last night in the SPX. And as you can see here, this level 68.50, it's a really big level that's right overhead. If we want to continue to make a move to the upside, that's going to be in our way. And then beyond that, 6,900, right? Those are two really big levels. Even if we did overshoot that, we got 7,000 up here with an even bigger level. Now, it's not just that level alone. We can see all this ancillary structure there. It's going to be very difficult to get through these levels. Right side tail risk is real, right? Market summary. S&P closed 1.2% higher, 68.75. That the U.S. and China have agreed to a trade agreement, which will be finalized on Thursday when the president meets Chinese counterpart. We'll see. All it takes is one side to have a little hissy fit, get salty. There we go. NVIDIA's performance was fueled by Scott Bissett's CBS News comments confirming no changes to the U.S. chip export controls. And then AMD gained 2.7 after a quick rebound, lifted by the Reuters report of a partnership with the U.S. Department of Energy to build two supercomputers. Because the government is picking winners and losers now. And when you have the government as your sugar daddy, well, what can go wrong? Yesterday, we talked about how far away we was from the 3-period moving average, and we talked about it in the Globex. We were 0.75% yesterday during that conversation. Yesterday, as we continued to push higher, we got more than 1% away, around 1.8. In the overnight, we again reached around 0.75% away from that level ish, right? You can see it. this isn't perfectly on the line and that's not perfectly on the line. We're just ballparking it here, around 0.75%. And if we expand again, matching the level of expansion that we did yesterday, that'll put us above the call wall. The call wall rolled down last night and the put wall rolled up significantly. That was a massive move in the call wall. It's now within yesterday's trading range. So they closed the gap. They brought it all the way through Friday's levels, through the gap, and now the put wall is sitting inside of Monday's price action. Now, one day, right, it can move one day up or down. It shimmers and moves, not a big deal. If it stays up here, that would be a big deal. We want to see where it's at tomorrow, how we end the week, what we do with it from here. But it's a lot easier to jump the put wall when you can reach the put wall. When it was so far away, the idea that it would act as a gateway to lower was hard to fathom, because with it being so far away, we would get exhausted just getting to it, and then it would act supportive, and it would be the place where they would monetize puts, turn everything around, and run it back up from where we came. With it so close, we just jump it. If they've got shorts on and they're running puts, why would you want to monetize at 50 points when you're used to, 200 and 250 points? Not going to get much bang for their buck to monetize their puts at this location. We do need to see how it plays out. A put wall that rolled up is supposed to be considered a very bullish bias or bullish behavior, bullish posture. That's the word I was looking for. It intonates a bullish posture to have the put wall rolled up so aggressively. And the comment about jumping the puts can be said about the calls too. The call wall rolled down. It's easier to jump that call wall when it's close to us, because we won't get exhausted just getting there. At this point, really all we need is a Globex breakout, and we can take a run at the 69.32 cog line and challenge that call wall, try to jump it. Zero gamma is 150 points to the downside. We are a long ways away. So dealers are positive gamma in a big way, and we're not looking for any sort of gamma flip, because it would take a radical move to the downside to even get us there, let alone get through that level and get underneath it with some distance to be considered in a completely negative gamma environment. The volatility trigger is right underneath this as well. So if we cross the put wall, we will also be crossing the volatility trigger, and that opens us up for some violence to the downside, which very likely would fuel the push and add to the drive in that downward move. So if you look at it on the daily, this gap from the highs is not normal. And for me, I've got every expectation that we're going to close this gap eventually. Butterflies are cheap. You could start layering butterflies on different expirations across that structure. 68.25. Since you could go farther out in time, or you could just put them on day by day. Like you put one on today for today's expiration, you put one on today for tomorrow's expiration, and then tomorrow you put one on for the next day's expiration, and just stay one day out. That way you're not trying to put a butterfly on 8 days out, which would increase the cost quite a bit. Just keep them at 0-day levels or at 1 day ahead. That'll especially be helpful for you guys that are still under PDT. Maybe you can't trade every day. Put the butterfly on for tomorrow's expiration, targeting that gap close. Since they're cheap, if you can lay them out for 5 pennies, which is as small as you can get in the SPX, then when it does hit, you're risking 5 to make 80 or 85, right? Max profit would be 95, but that's unrealistic to aim. Actually, it's 490, right? The spreads are $5 wide, so if you're risking 5 pennies, your max profit is 495. Never expect to actually get max profit though. So, you could aim for 3/4 of that. 67.92 cog line for the SPX. We closed at 68.75. So you're not quite aiming 100 points out. That should be a really cheap butterfly, all things considered. And running that really cheap butterfly every day until we get back down there and close it. I mean, I wouldn't run it. If that gap's there for a month, then, it's unrealistic to run it every single day. But it should close within this week by late case Monday. So if it wasn't closed by Monday, then I would just stop running them. But those gaps will get closed eventually. And it's not normal to have these gaps at the highs like that. Not in the SPX, right? This isn't some fly-by-night company. And don't get me wrong, we've left gaps, right? Like back here, we've left some gaps and another one there. So it's not like the gaps are always going to fill right away, but most of the time the SPX gets those gaps taken care of. Below the 3-day, we have a long drop to the 10-day, which is 68.06 basically. It's a 60-point drop from the 3 to the 10, and then another 40-point drop down to the 20. So, that would be pretty significant just to even see the 20, let alone get through it. Not to mention we'd have to get through this previous structure, and there's a lot of support underneath this from that structure. $69.50 is 50% of this measured move, right? Measuring the pullback and projecting higher 50% and 100%, $69.50. Volume was a little light last night, 58,000. We've been running in the 60s and 70s, so 58 comes in a little light, but really 58 was the norm. These higher numbers where we've been seeing 60s and 70s, that was a bit elevated, really. But we were getting it so often that the elevated numbers was starting to be normal. And now 58 seems a little light when, that's really what a typical day is supposed to look like. We are pretty balanced this morning. We're not really too close to either side, which makes sense because if you look, we haven't really gone anywhere. it would be easier to hit the lower ADR since it is inside yesterday's range, and so are we. But if we do get the breakout of yesterday's range, then we want to target 69.54, which is the upper ADR. Just remember, it always starts with GTFO. You got to get out of this box. Well, that box is also a condition of a breakout for yesterday's price. So we're talking about getting an inside day breakout to continue that move to the upside. Otherwise, if we break our own Globex low, target the midpoint and then this lower ADR. For the mid, you have the RTH mid, 68.94. And then you've got the full mid, 68.88. And then you've got the gap measured mid, 68.68, which really, that one, you could just call it the low of Monday. It's close enough. And there'd be a line there anyways. You're talking about 4 points. And in such a range like this, 4 points is nothing. This mid, I would just run it to the top of that bar. It's a liquidity bar anyway, so why not? And the RTH open to kind of fill in that big gap. Level by level all the way down to here. And then if we overshoot that, we got this level. Yesterday, we developed a missed daily pivot. We can add that to Friday. So that's 2 days in a row with a missed daily pivot. Now we're working on the third day. Today's pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. Markets want to hit their pivot. The fact that we got within the channel and we didn't hit that pivot, to me, is bullish. We were so close to it, gravity alone should have just brought it down into it, and yet that didn't happen. Now, it could have been a lack of participation, but it really stands out that we didn't hit that. So at this point, hitting it would be a bit of a tell on weakness for us to actually go down there and get that done. If we get below it, we aim for the bottom of the channel. And then if we get below the bottom of the channel, we've got our S&R line. $68.81. Now the indicator is biased to the upside right now. You can see that the distance to S1 is less than the distance to R1. In fact, R1 is almost double the distance. The indicator is, quote, smart in its measurement, showing that there's a higher probability that we go up than down, which is why it has expanded the R1, moved it farther away. The bottom of the channel is 68.91. That's a cog line. If that breaks, we run it. S1, yesterday's low, S2, the gap close, S3. That gets us inside the weekly floor pivot. So then we target the weekly floor pivot after that. That would be if things start to get really nasty. Otherwise, to the upside, we break yesterday's high, break the Globex high. We got R1, R2. There's some options levels up here like 69.50, 69.32 cog line. That's R1. 7,000. The little bit of an odd distribution. It's not quite the classic D shape. Has a little bit of a shallow area in it, but it's not shallow enough to call it a double distribution at this point. I wouldn't call it that. Still, there was some elevated trading across the highs before this pullback. We're running right back up into that same zone. Value area on the lower part of the distribution. And the point of control is 68.88. That'll be our line in the sand. Get through that point of control. We should be able to test the low end of this. The entire setup, if you zoom out, this is an island at this point. And it can be an island reversal where we gap back down, or we can just trade and come running back down. It doesn't have to happen with a gap. And the ES is another one of those that generally closes its gaps. So, you can find gaps on the daily that are not closed. You can, but there's not a lot of them. And they usually exist because there was some significant news, either in Fed or liquidity, bonds, treasuries, commodities, something like that. Some big significant move that pushed us to an extreme, and then we never went back and got the gap closed. Otherwise, most of the time, we get these gaps taken care of. Even this one from way back here, we eventually got that closed in that big red bar right there. We came down and crashed that level plus some. Ten-day, 30-minute volume profile and TPO. We've left behind the profile. We're building a new one up here. If we break through the bottom of this range and we try to close the gap, there's a significant structure at 68.40. It's basically the high of last week. That's where the price shelf is built, right across those highs. So they really came in and put a lot of work in across those highs into the close last week. It didn't do them any good. If all of that is short sellers, they got run right the hell over. Which is likely a part of the fuel we saw yesterday, right? Because markets need shorts to continue to go up. I know that might not make sense to newer traders, but that's just the way it goes. Otherwise, right now on this time frame, we do have a nice classic double distribution up here. The shallow area is at its best right at 6,900. Interesting that there's a complete lack of participation right on the line, 6,900. But above it, within 8 points, and below it, they really filled it out. I've been saying that we're not running the round numbers, the roundies is what they're called, the 6900. We're running the 50s. So maybe that's just more examples of the 50s getting hit, not the roundies. Because same thing here with the 68. It's flat, right? There's just nothing there. And we jumped the 50 completely. So talk about a lack of, a lack of volume. We didn't go there. So there's nothing printed there. That's certainly a shallow area. We have a new VPOC from yesterday, 6884, it looks like. That's not to the tick, but it's close enough for me. Maybe it'd be 1 point higher at 65, 6885. You can see that volume that came in on the close yesterday. Look at that structure way up there. We want to carry forward that structure into today, right? That's the zone. And sure, we've gotten through it and now we're back through it again, but I would keep that zone on your radar all day. 68, 6911 cog line. Yeah, the commissions do cost more than the options trade on those SPX, right? Yeah, that's how it goes too. Which I guess, if you're running on Tasty and you can run 20, 30, 40 of them, commissions stop after the 10 lot. So anything above the 10 lot is commission free. And we are really close to the edge of the weekly expected move. Now, I mentioned this yesterday, right? How on an FOMC week, a lot of times we just go sideways and we don't do anything into FOMC, but that there was examples where we ran to the edge of the weekly expected move before the FOMC and then we stalled out. Well, there we go, right? If we get into the weekly expected move and we stall out there, that might be the stopping place into FOMC. No, I don't think they discount on the futures either. When it comes to the commissions and the 10 lot rule, I think that's strictly for options on, and it might not even cover the SPX. I think it's more of like the ETFs and stocks. But they do have a commissions page where they very clearly lay it out. I just don't remember what it said. Rather than buying data for crude and gold and all that, I trade futures at Tasty on the commodity side, and then I use my Tradeovate account with the data that I bought to trade the indexes. But I've also picked up a couple of prop accounts now just because of the lifetime data. So I've been running commodity trades on a prop account just because that lifetime data is cheaper than the commissions at Tasty and it's cheaper than buying the data at Tradeovate. So there's ways to get it done, right? I'm not a big fan of running those prop accounts, but I mean, lifetime data pays for itself. So we are still a bit elevated on our distance from the 10, but not extreme. And you can see how we're pulling back. We didn't get too far away. And now that we've already started to pull back, our risk of some sort of mean reversion has decreased significantly. We don't have a mean reversion dynamic at this point. So I wouldn't look for that. It doesn't mean that we can't go down, just that we didn't, quote, travel too far too fast, and it doesn't owe us any sort of a pullback at this point, not on the daily. And if you want a better math, check out a Z-score indicator. That'll really help if you are looking for stocks and indices that have moved too far too fast. A Z-score running on an hourly or a 2-hour, maybe a 4-hour, would be a really good tool to catch that dynamic of, quote, too far too fast. Looking at the 10-week, we're 3.5%. And if we zoom out, we've been higher than this before. We generally don't stay higher than this, other than, I mean, there's a few clusters where, news and tariffs and all that got us higher and held us up there longer. But a lot of the times it's a one-day wonder. We peak above 4 and we drop back down again. So we can get in these dynamics like back here where we stayed really bullish and we stayed above 4% through this zone here too, and then through this zone coming out of that April tariff drama. It does happen in clusters, but more often than not, when we get above 4, it's a one-day wonder, like here, 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 and then we just drop right back down again. So if we're going to hold above 4%, we're going to need to keep the fire going, right? We want to stoke those flames with news, headlines, earnings, drama, anything positive that we could throw on the fire, right? Without that, I think we just lose muster and fade on back down. And that's not bearish. It's just, we're just talking about normalizing and get back within a 2 to 3% distance of the 10-week. All right, China's down with gold. Mag 7 down volume is down. Yeah, that's a double negative. Combined, it's almost down 7% in 5 days. China again, a little bit of Bitcoin, metals and mining, and that's where we run out because we want things that have moved at least 0.5%. So we've got things that are moving in that direction, like energy is down, it's just not down enough. Staples down, but not enough. Banks. So flip it around, look at the other side. Uranium, Mag 7 up volume, the mags, quantum, healthcare, that's USO, UNH, my bad. UNH, positive news, gave that a bit of a boost. Not as bullish as yesterday, right? Remember we were looking yesterday and we had every single one of the things that we need for a rally day yesterday. We don't have that today. We still have the Mag 7 and we got some cheaper penny stock stuff like quantum, and that really does help. But other than uranium, quantum, and chips, that's about all we got. I'd really like to see Bitcoin come back into the game. And I think shorting the airlines is probably still a really good bet since the government shutdown continues to weigh on them and more airport employees are calling in, I'm sick. Yeah, they're sick. They're sick of working for free. They have a term for that, right? What do you call it when you work somebody and you don't pay them and you make it mandatory where they can't say no? Oh, yeah. Didn't we abolish that? I heard some proposals that they were talking about not paying the back pay of government employees when they do get the government back up and running again. That's really going to get people fired up. Talk about building morale. Yeah, hey, go to work. not only are we not paying you, but we might not ever pay you. We might just decide to forego your pay for the time that you worked for free. Yeah, I don't think that's going to fly very well. So uranium, solar, mags, utilities. This isn't the structure that we want to see for a rally day. Keep our eye on gold. That could be a bit of a tell, and Bitcoin. I think those would be the simplest ones to keep your eye on. Otherwise, dollar and bonds would be a good place to look. The Trading View's got the JGB 10-year too. It's worth taking a look at that. Keep your eye on Japan. What I got for you guys, be careful, be safe.